Welcome to the weekly update, where I'll go through the action in the market for the week of May 15th through the 19th, and then we'll see how things look for the week of May 22nd through the 26th. We had a positive week. We were up on the S&P. Most of the indexes ended up being up. We're looking a little bit more positive, but especially on the daily charts, we're running into a lot of upper resistance. We're also seeing a lot of negative divergences, and I won't go through those as much in the weekly video, but I cover them extensively in the daily video. This typically can just suggest that there's not a lot of built-in strength in the market because we're seeing these negative divergences that at some point may come in and really take things lower. But for right now, things are looking fairly positive, other than we have resistance to deal with. A few things to start with. I do have a supplemental video that I posted about 2 weeks ago. It deals with the S&P 500 and interest rates and a lot of different charts that I show to kind of bring that all together. The charts haven't changed all that much. Some of them are weekly charts. So feel free to view that and see if it gives you any additional insight. I do have a PDF of all the slides and charts that you can download in all the different videos that I upload. I do have a private Facebook group that you're welcome to join. I don't have a poll this week, but I will be preparing a poll for the upcoming week. And videos that I prepare are also posted on Rumble. This past week, I ran into a little difficulty with YouTube where they just took my whole channel down. Some kind of bot or some program came through and didn't like what it saw, and so they just wiped everything out with no warning to me at all. I quickly appealed that. A couple hours later, YouTube came back and said, oh yeah, we checked everything out. There's no problems here, and the channel is back up. If you have come to realize that the videos that I post are of value to you, and you go to YouTube and I'm suddenly gone, also know that I post on Rumble as well, and here is the link to that particular channel. Let's go back and talk about what happened this past week. We were up 1.65% for the S&P, but volume overall is below average. Now on Wednesday and Thursday, we had pretty good up days, and the volume did pick up, so that's encouraging. But all the other days, we tend to be below average. The technicals are mostly positive overall. We're looking positive on the daily charts, but we do show some warning signs. There's always warning signs that we need to be aware of. But for right now, things are still looking okay, but longer term, it's looking like it's not really being built on a solid foundation. So we'll just have to be prepared for that. Inflation and interest rates are still the big backdrop to the market right now. But we have this debt ceiling issue that's being dealt with or not dealt with, and the market is starting to get a little jittery about that. That could produce some weakness. Last week on Wednesday and Thursday, a lot of the upward movement is being attributed to the idea that this debt ceiling issue will get solved. Is that one of those situations where they will buy the rumor and sell the news? We don't have anything really concrete yet about this, so hopefully within the next few days something will be worked out. Our trend is still weakening, but it is positive with the green line on top, and I will go through that chart. So for the week, the Dow was up 0.4%. The NASDAQ, which has been leading the way higher, and the NASDAQ 100, it was up 3%. The S&P was up 1.6%, and the Russell was up 1.9%. We saw a little bit of renewed strength in the small caps, but they're still lagging behind overall. So for the week, just to go back and talk about what happened, the S&P was up, and it hit a new closing high for the year on Thursday at 41.99, just under that 4,200 level. We did hit a new intraday high on Friday at 42.12, but then we ended up closing down below 4,200. The 4,100 level continues to be a pretty important support level for the S&P if we start to fall. There are a lot of negative divergences, which again, as I said, can lead to longer-term weakness. Right now, it's just a few of the mega cap stocks that are really having the biggest influence on the market. There was optimism about the debt ceiling deal. On Tuesday, the president and congressional leaders met. We really didn't get much out of that meeting. But then on Friday, there was a report that came out that said the two sides are still pretty far apart. Volume was below average. But, as I said earlier, when the S&P really started to go up and break out of this trading range that we've been in, we did see some pickup in volume. Also, during the week, Dallas Fed President Logan came out and said that the current data doesn't yet support the Fed pausing their rates in June. Fed President Byrd, who's not a voter any longer, acknowledged that there's a need to raise interest rates further since inflation remains persistently high. Now, when these folks say something, the market can latch on to that, but it's when Fed Chair Powell speaks, that's when the market really listens. Interest rates and the dollar were up on the week. And then key retailers reported their earnings this week, including Home Depot, Walmart, Target, and Foot Locker. Some of those were positive, some were taken as negative. So on Monday, the S&P closed near the highs of the day, but it only had a modest gain. There is a little bit of a pickup in M&A activity, mergers and acquisitions, and that's typically indicative of a more healthy environment. You would think that companies would buy other companies when their stocks are really low, but that doesn't seem to be the way that it always works. Newmont Mining came out and said that they have plans to acquire Newcrest, and then it's either Oniok or One OK, I'm not sure how to pronounce that. They plan to acquire Magellan Midstream Partners. Not so much that we're into the names of these companies, at least in the analysis that I do, but just the idea that, there is some M&A activity starting to pick up. EU regulators also approved Microsoft's acquisition of Activision. And then on Tuesday, the S&P fell after it was reported that the president will cut his trip to the G7 short. That's happening right now over the weekend, and that he would skip visiting Australia. House Speaker McCarthy came out and said that the two sides are still very far apart. Then you had Chuck Schumer come in and say that everyone agreed that we need to be bipartisan and that having a bipartisan bill in both chambers is the only way we can avoid a default. Well, okay, stating the obvious here. Then on Wednesday, the gains were built up throughout the session. The S&P rose above the 4150 level. Then hope emerged about the debt ceiling negotiations. Then on Thursday, the S&P was able to get above 4,200, but it closed just under 4,200. McCarthy came out and said again that he sees a path to getting the debt limit bill on the House floor in this upcoming week, but there were other reports that came out that said that this won't be a very easy thing to do. On Friday, it was options expiration day, and we actually saw a decrease in volume, which is kind of strange. The S&P went back above the 4,200 level, but then ended up falling down below that. Fed Chair Powell had a nice little chat with former Fed Chair Bernanke and said that inflation is far above the Fed's objective. He also said that the rates may not have to rise as much because of credit conditions. That could have freaked out the market. That means banking problems here. And then there's this site called Punchbowl News. Maybe some of you are familiar with it. I'm not. They put out a tweet saying that the debt limit talks between the White House and the House Republicans have paused. So that kind of spooked the markets a little bit. CNN came out with a report that said Treasury Secretary Yellen met with some of the bank CEOs and said that there might need to be more mergers needed, meaning the bigger banks may go out and buy some of the smaller banks. That could suggest that there are some problems, and that made the market a bit gun-shy as well. The S&P closed just a little bit below 4,200. Looking at some Isabel net charts, the insider transaction ratio, which is legal insider transactions, these are corporate officers in a company, whether they're buying or selling their shares of the company that they work for, but they have to report what they're doing. It's dropping off a little bit and actually getting down to being more bullish, where they're getting more extreme negative. We're looking at earnings per share, and they say it typically falls by 13% during historical recessions. This chart was updated on May 11th. Right now, they're predicting that we'll be down about 10% as far as earnings. This chart just shows where tech is coming more back into favor, and we're seeing a lot of money going into the tech sector. And then in 2022, a lot of folks implement what's called a 60-40 strategy. 60% in stocks, 40% in bonds. That just got wiped out in 2022, but so far in 2023, we're up 28% using that strategy. Then the profit margins, they expect them to contract to 11.3% in 2023. This is put out by Goldman Sachs. The consensus is a little bit more optimistic, where Goldman Sachs, they have them going up, but they're lower than what other folks are thinking. What are people putting into their portfolios? we're seeing a real increase in debt, which means bonds. And bonds have been more favored in 2023 as interest rates go up and the yields on those bonds are more attractive, hopefully getting to the point where the yield that you're bringing in is greater than the inflation rate that we're dealing with. Also, the debt ceiling crisis, this goes back to 2011, the last time we had a major shakeup with this. And what happened around the market? Well, during that time, the S&P fell 17.3%. Gold was up pretty strong. Bonds were up strong. And the VIX really shot up as well, meaning we were going down in the market. Looking at a FactSet blog post that was posted on Friday, it says fewer S&P 500 companies are using the word recession when they make their earnings calls after their earnings report comes out. Over on the right, it has decreased from what they were saying before. Then current market valuation, they still have us at fairly valued, even though we're getting closer to the top end of the fairly valued signal. To go through some of their charts, here is the historical chart showing that we're just underneath this one standard deviation. If we go above that, we'll be considered overvalued. Then looking at the different valuation models, the Buffett indicator, which looks at GDP compared to stocks, it is overvalued right now. It's slightly above the one standard deviation. The price to earnings model is also showing that the market is expensive. We're overvalued currently. Interest rate model, because we have a lot of interest rates that remain inverted, it is still fairly valued overall. The mean reversion, we're getting above this one standard deviation because the market's been going up, where the historical trend line is this gray line. If we stay above this, we're overvalued. And if we get all the way up to the 2 standard deviation, then we're extremely overvalued. Looking at some recession indicator models, the yield curve model is still very high, again, because we have a lot of the yield curves that are inverted. Looking at our state coincidence model, this continues to fall overall, which is pretty good. When this chart is really going up, that does also suggest that a recession may occur. Our market sentiment models, margin debt, folks are starting to get back into the market. It's still neutral overall, but we're seeing a pickup in the use of margin. And the junk bond spread, it is also neutral. It is below the historic trend line. Looking at some charts from Real Investment Advice, this is just showing that earnings are starting to show some improvement overall after they had been in a real decline. This chart shows the earnings per share, where in the fourth quarter we were negative. They expect us to be down in the first quarter, and they're projecting that we'll have negative earnings growth in the second quarter. But when you look at forward-looking estimates, they remain very optimistic overall. And we look at the Economic Output Composite Index compared to the LEI, which we had a recent reading on that this past week. It shows them both in decline, which may suggest that a recession may occur. Then we look at the LEI 6-month rate of change and compare it to the earnings per share rate of change on an annual basis, where they both continue to decline overall. Then we look at GDP against the earnings on an annual basis. They are both declining as well, but GDP is still positive. And then we look at inflation, which has been coming down, and the earnings per share, which has also been coming down. Eventually, we would like to see the earnings per share turn and go back up if inflation is in fact continuing to fall. And then this says that earnings estimates are well ahead of economic realities. We're way above the earnings growth trend line, which is yellow. Then it says the deviations of earnings, either above or below the long-term growth, were coming down because we are pretty optimistic about those earnings. And then the corporate profits. They're well above this red line, which is the power curve, showing corporate profits after tax. This could also suggest that the market is overvalued. And then looking at M2, which is the money supply, where it has been coming down, and then GAAP earnings have also been flat to slightly declining. Then looking at our charts, here's the intraday chart going back to Monday, where we had a slight up day on Monday. We were pretty much flat on Tuesday, but then saw some weakness going into the close. Wednesday and Thursday were the strong days. We saw pretty solid strength. The interesting thing about this is it was later in the day when the market really took off and went higher. There's this adage on Wall Street. It's the amateurs who open the market. It's the professionals who close it. So once the amateurs get out of the way, and the first couple of hours of the trading day are gone, then the professionals come in and then do what they want to do with the market. Then on Friday, we did start out more positive, but then we ended up coming down. You could say that the market was a little bit exhausted on a short-term basis, and then this negative news hitting the market also really kept a cap on things going higher. For the week, the NASDAQ 100 was up 2.91%, and the NASDAQ was also up. The S&P had a fairly good week. Now, please keep in mind, these are just the 5 trading days. This doesn't go from Friday to Friday. It just goes Monday through Friday of this past week. The NYSE was up just a little bit. So all the indexes ended up having gains for the last 5 trading days. Year to date, we have the small caps, which are down, but all of the other indexes are positive. And then going back to the all-time high, we're still negative overall, with the NASDAQ and small caps now coming in last place. Looking at our different sectors for the week, the tech and communication and discretionary, they did about the best, where we saw weakness in staples, real estate, and utilities. So this is growth, tech, communication, and discretionary. These are more growth areas, and that's what really helps the market to go higher when that sees favor in the overall market. We also look at our relative rotation graph. It shows that the XLC, which is communication, and XLK, which is tech, these are the leading sectors right now, where we have a lot of other sectors that are weak. There are some that are improving overall, but still, it's just suggesting that there's only a small part of the market that's really propping things up higher right now. Then for the week, on the sectors, we had tech, discretionary, and communication that were up. We had staples, real estate, and utilities that were down. Year to date, we still have communication, tech, and discretionary doing the best, where some of the more value areas continue to be underwater. Then going back to the all-time high, energy is still in the lead, but it has given back a lot of its gains. Staples are still positive since then, but all of the other sectors still remain negative. Looking at sentiment, we're still in the positive camp. We're not giving an extreme reading right now. And here's the historical chart. If we come back up to the 75 level, that's when we will get extreme positive. Looking at the active asset managers, they're pretty much in the middle right now, not giving us an extreme reading. The VIX still continues to be very low, suggesting that there's not a lot of fear in the market. It did tick down. We're well below 20 on the line chart as well as the bar chart. The RightX Bear Bull ratio did spike up just a little bit here, but we're at the midpoint. We're not showing any kind of extreme fear right now, nor are we showing a lot of optimism. Then looking at the 1 to 3 month T-bill, which you could say is cash, comparing it to the tech sector. When this black line is going down overall, that means tech is in favor instead of being in cash. The beginning of 2022, we saw a real shift in this overall ratio, but now it has been coming down, suggesting that tech is still in favor. Then looking at the latest reading of the AAII survey, the individual investors still tend to be fairly pessimistic overall. We really pay attention to this when it drops below 20 or goes above 40. This will likely go up a little bit in the next reading because we had an up week. The Ulcer Index is also suggesting that there's not a lot of fear in the market. Looking at the economy, the latest estimate from GDP Now says that we should have growth in GDP of about 2.9%. The consensus is anywhere from about 1.5% to being down a little bit over 1%. Then here's the GDP Now chart showing that we're still looking positive. Then I've actually been able to create my own chart when we look at the spread between risky and not as risky bonds. It's going up just a little bit, but we're not really getting a real high reading right now. You'll notice at the bottom that we like to have a correlation that's negative, meaning that as this is coming down, that means stocks are going up. So they're having a tendency to go in opposite directions. Then looking at the latest reading of the Financial Conditions Index, we're still below this black line and we actually declined slightly. These next few charts have not been updated since the last weekly video. It just shows that banks are really increasing their tightening standards. The real-time SOM rule, we're still below the black line. We have not crossed above the red line. That's when we are in a recession. The smooth recession probabilities also giving us a pretty low reading right now. The Brave Butters leading index is ticking up just slightly. We'll want to keep an eye on this, but this isn't updated all the time like some of our other charts. Looking at inflation, the inflation nowcasting still shows us pretty much sideways. At the end of this upcoming week, we'll get the PCE report, and that will be another inflation gauge that we watch. Looking at the Fed, as of the close on Friday, there's an 82.6% chance that the Fed will keep the rates the same. They're not going to raise rates at the next meeting. Looking at the Fed balance sheet, it is starting to decline again. And here is going back 1 year, showing how they are having assets coming off of the Fed balance sheet. Looking at breadth, we're still positive overall based on price, but we're showing a little bit of negative divergence based on volume. And we're seeing that same thing on the daily charts as well. The new highs, still looking a little negative overall. It finally picked up in the latter part of the week on the daily charts, and we're not seeing a lot of strength right now. The new highs are increasing, but not enough to turn our moving averages back up. The advanced decline ratio is declining, but still above 0. Accumulation distribution still remains positive. Our trend, this shows the ADX well below 20 and declining and below its moving average. However, we default to positive because the green line is on top and it advanced. Our Arun is looking a lot better. The oscillator is showing that things are back to being positive. The mass index is not generating a signal right now. Looking at a daily chart, I've also drawn an additional trend line here, going back to these two lows set earlier. We finally were able to break above this resistance level. Now we have 4,200 above us right at this other resistance level. Can the market get up enough steam to actually climb above that? Our trend channel shows that we're a little bit above the midpoint of the trend channel. The pivot points are also positive. We're above the monthly pivot. And we're above the 50-period simple moving average. And our long-term trend continues to be positive. The Swenlin trading oscillator improved based on price and volume where we crossed back above 0. The McClellan oscillator, it's still below 0, but showing some improvement. And our summation index is declining based on price and volume, and we're below 0 based on volume. We've actually started to turn up on the daily chart, and we're just barely starting to turn up based on volume on this chart. Sometimes that gives us a leading indication of what will happen, but other times we also get faked out by it. The PMO is still positive on the weekly chart. We're declining based on price, and we've dropped below 0 based on volume. Looking at our PMO study, showing some improvement overall with the PMOs that are rising. We're turning back up with the buy signals, but we're still declining with the PMOs that are above 0. The BPI, and we're seeing this exact same chart on the daily chart. We came down to this 50 level and we bounced up off of that. So this is turning back more positive. The Bollinger Band %B indication is not giving us an extreme reading. Looking at our oscillators, on the daily chart, the slope has turned up and the MACD has turned up. The slope is rolling over a bit on the weekly chart. We're still positive with the TSI and the MACD. The PMO and the PPO continue to be positive. And then our longer term oscillators are also positive, but the KST is rolling over slightly. Looking at the Chaikin money flow, it is showing continued strength, so that's positive. And the Chaikin oscillator is also positive. The force index continues to be positive. The money flow is also positive. The rate of change going back 1 week, we were up, so this is increasing. Going back 50 weeks, we are coming back above the dashed line. That's improving. The RSI is above 50 and advancing. That's positive. The special K, we're starting to drop below this red line here. On the daily chart, we came right up to the red line and potentially crossed over positive, but that is being rejected so far. Here, we're coming down and we could be crossing over negative, but so far that has not developed into a signal. The Stochh RSI is extreme positive, as is the Williams %R, and the ultimate oscillator turned down a little bit, but is still positive overall. The Vortex has the green line on top, although it is declining. The Copic curve, which generated a new signal on the daily chart, is pretty much going sideways on the weekly chart. Now, the signal that was generated on the daily chart, that was just about at the 0 line. When we get good, solid signals from this indicator is when we get an extreme negative reading and then turn up out of that. There is some idea that maybe this sideways action that we've been seeing in the S&P is a consolidation in and of itself without the market really going down. On the weekly chart, we're still above all support levels that we plot here. Looking at our different charts, the Heiken Ashi on the weekly chart is positive. The Kegi is positive. The Renko is positive. The 3-line break is positive. The ease of movement shows a little bit of improvement, but we're still slightly negative going back 14 periods. Since we had an up week, the 1 period ease of movement is showing that we're positive. There were no new X's or O's drawn in the point and figure chart, but we did have a signal that was generated. It says an ascending triple top breakout that occurred on May 15th. On the 18th, we also saw a breakout signal on the daily chart. Looking at our different trading systems, the Elder Impulse system for the S&P is positive, and the dots continue to be below on the parabolic SAR. We saw a switch this past week where the parabolic SAR on the daily charts had been negative and then switched over to positive, so now we're seeing a confirmation. Looking at the broad market, here's the S&P, the mid caps, and the small caps, which continue to underperform. The Dow is still in an overall uptrend. The Nasdaq has been leading the way higher, and it is also in an uptrend. The Nasdaq 100 is also doing quite well right now. The mid caps are showing some weakness, but not enough to give us a death cross. Now, we did see a death cross on the daily charts, but it hasn't come up yet on the weekly chart. The small caps have given us a death cross, both on the daily and weekly charts, and they've been really underperforming. The NYSE has been showing some weakness, but is still in an overall uptrend. The Wilshire is also looking a little bit better. Looking at all stocks, we continue to be positive. The biggest software company is also pretty much going sideways, but still positive. FANG has really been doing quite well lately, and that's in an uptrend, where ART continues to struggle, but it was up on the week. Looking at traditional Dow theory, where we're seeing a little bit of additional weakness in the transports and then more recent weakness in the utilities. So that's another negative divergence we want to be aware of. The bank index continues to fall overall. The MACD is declining, and even after giving us an extreme negative reading, the RSI has not really turned positive yet. Looking at all deposits in banks, they continue to fall, even though we saw a little bit of a tick up in the latest reading. Looking at the broad market, the CRB continues to be in a downtrend. Copper has been showing some weakness, but it's still in an uptrend. However, if we see more weakness in this chart, we will develop into a death cross. Oil has been dancing right around the 70 to 71 to 72 level. The dollar has been trying to bounce back up. Now, if we see some shorter to intermediate term strength in the dollar, that could end up producing some headwinds for stocks. When the dollar was really going up in 2022, that was putting a lot of pressure, pushing stocks down. When we were coming down with the dollar, that gave support to stocks. We'll have to see if this is just a little bit of a bounce or if this is going to turn into some kind of a significant bounce. Gold is still in an overall uptrend, as is silver. Then looking at bonds, bonds continue to be in an overall uptrend, even though they didn't have a really good week. Yields have been going up lately as bond prices have been going down. And looking at the stock to bond ratio, stocks are still outperforming bonds. Then looking at the world yields, where you have the US, the UK, Japan, and Germany here. Japan's its own little story that we're keeping an eye on, but interest rates did go up pretty much across the board. Then looking at the MOVE index, the MOVE index measures volatility in bonds, and we're not really getting any kind of an extreme reading now, where the VIX, which measures volatility in stocks, that continues to be low. Down below here, I have a spread between the VIX and the MOVE index, which is the green line, and the red line is the S&P, and these two have a real strong correlated relationship. A weekly chart with the 1 month yield, and then we subtract out the 3 month yield, where this had really dropped off, and then it really started to spike up, and now it's starting to come back down. A lot of this movement could be attributed to what's going on in the whole debt ceiling crisis, even though we didn't see that same kind of a move back in 2011. It could also be feeding into this banking issue that's been happening. Our relative studies, looking at our intermarket analysis chart, oil is still doing the best, going back to the beginning of 2022, where the dollar has now been able to overtake the rise in gold, which is the yellow line here. Stocks and bonds still continue to be underwater. The Nasdaq is really outperforming the S&P 500, and the S&P 100, the big stocks, are outperforming the rest of the S&P 500. Growth is showing some improvement here. It's still in an overall downtrend, but it has been showing some underall strength. And if you want to know where the strength is coming from in the small and mid caps, please watch some of the daily videos where I go through some charts showing that even though both of those indexes have really suffered, we're seeing a lot of strength in growth. And that's where we get the real power from. That also could be where the smart money is coming in and buying on perceived weakness. Then looking at gold, it's still performing better than the S&P 500. Bonds continue to underperform the S&P. And then gold to the dollar. The dollar's been doing well and gold suffered a little bit, so we went down, but we're still in an overall uptrend. Then the low volatility stocks, we saw a recent death cross with this ratio and it's continuing to fall. Under the surface, we're seeing more favor into the growth stocks. Energy, which was the place to be in 2022, is now seeing a death cross when compared to tech and is starting to underperform. Discretionary, showing some improvement when compared to staples, but is still in an overall downtrend. Then a look at some of our secular and cyclical trend studies. The NYSE breadth thrust, this signal was generated last October and it's still on the books and will remain on the books. And then we have the ZWAG NYSE breadth thrust, which also generated a signal, and this will remain on the books as well. Our momentum studies, again, when we go back to 1998 to 2004, we were faked out a couple of times when we broke out above this downward sloping trend line. If you look at the MACD, it was showing some real weakness at that time, and it was still below zero. The MACD was improving a little bit here, but again, well below zero. We also saw that same thing with the MACD going sideways back in 2008 when it looked like we could have been breaking out above this trend line. So we compare that to right now, but we're seeing a different story. The MACD continues to be above zero and it is above its moving average and advancing, suggesting that at least for right now, this breakout above this trend line is legitimate. So what's our outlook for the upcoming week? Here is the economic calendar. The most important one will likely be the PCE report coming out on Friday. Our technicals are still positive overall. We have some things to be concerned about. The markets are fixated on the debt ceiling right now, as well as any more banking information. But the underlying scenario that the market's really dealing with has to do with inflation and interest rates. Then we only have one speech coming out that's scheduled for a Fed official. Governor Waller will be speaking at 2:10 on Wednesday. Then looking at the Stock Traders Almanac statistics for Monday, we did just finish options expiration and we were up on the week, where typically over the last number of years, we've been down more than we have been up. Now, what about the week after options expiration? Because since we had an up week this week, a lot of times what happens in the next week is we see the opposite. But historically, we've been up 64% of the time and down 36% of the time. Then for Monday, we're more negative with the Dow being up only 33.33% of the time. The S&P is neutral to negative, as is the NASDAQ. And then in the month of May, we tend to be more positive than negative, but we see more weakness as we get into the middle to latter parts of May. Then the yearly backdrop just shows that our barometer is still giving us a score of 3.0 because we had the Santa Claus rally in late December, the first 5 trading days of January, and then January was up. So that gave us a 3.0 score. When this happens, good things tend to happen for the market. And then it also likes that we're split between Democrat and Republican in Congress. Here's a chart showing historically what has happened in all the years. That's the black line. And then in pre-election years. And in both instances, coming into the middle to latter part of May, we do see some historical weakness overall. This also showing that same thing where we have a pre-election year after we had a midterm bear. That's what happened last year. It is also suggesting that there could be some weakness in the latter part of May. This is suggesting that same thing when we compare it to the pre-election year. We pay attention mostly to this green line because that's a pre-election after midterm bear. Then this is also suggesting that the weakest month tends to be May, but in a pre-election year, we tend to be a little bit better overall. That's the blue area that we see here, where if it was just a regular midterm year, we would be negative. But when you compare it to all the other months that are cited in this study, May ends up being about the weakest month. The debt ceiling debate. This is also put out by Stock Traders Almanac, and I would really recommend getting their book and even subscribing to their web service that they have. This goes back and compares 2011 with what's happening right now. The blue line is the S&P. The black line is what happened back in 2011. And then there's some annotated information here about what happened along the way. This chart also looks at the performance before and after there's been a debt limit change going back to 1950. A lot of times we do see some weakness after there has been an agreement that has been reached. Looking at our scenarios for Monday, hard to go with the down one right now, but we are seeing a lot of negative divergences, especially on the daily charts, and we have a very weak trend. The ADX has crossed above its moving average on the daily chart, but we're still well below 20. It's hard to go with the up one as well unless we really break above that 4,200 level, but we're still just not trending. So we're still favoring this more sideways pattern, even though the ADX is above its moving average. As I said, it's below 20, but the green line is advancing. So our warning signs, and this just applies to Monday, but these don't change all that much. We are seeing a lot of negative divergences. The VIX is still showing a lot of complacency. The new highs for the S&P are lagging, but they finally turned up and are looking to be improving. The NASDAQ cumulative new highs, new lows are also showing weakness. There's a real divergence there where the S&P has been going up and the cumulative new highs and new lows for the NASDAQ have been going down. The S&P is underperforming utilities, but we're seeing a little bit of life in that ratio right now. The risk-off posture, meaning folks are getting out of stocks and into bonds, that could be changing. We're seeing that chart shift a little bit right now. The small cap index is underperforming unless you look at growth, as well as the mid caps, and it just generated a recent death cross. Is the NASDAQ getting exhausted at this point? We're really breaking out to the upside. Are we going to see some kind of a pullback which could influence the S&P 500? And then earnings season is continuing right now, but we're coming to the end, and that can be positive or negative. Some positive signs. On the daily chart, the Copic curve did generate a buy signal. We have this long-term seasonality and setup patterns that we're looking at that do remain positive overall, and those apply to the whole year. Lower price levels may provide support. On the daily charts, we're looking at 4,100. If we drop below that, 40.80. If we drop down below that, we're looking at 40.20. The NASDAQ is still breaking above resistance. Small and mid-cap growth is showing a lot of strength right now, even though their indexes are showing a lot of weakness. Is the market bottoming by going sideways? That's one scenario that we're kind of playing out right now. And when they come up with a resolution, will this produce some kind of a short-term rally, or are we seeing a buy the rumor, sell the news impact happening right now? Here's a little disclaimer just saying that no, I'm not a certified financial anything right now. I'm an educator. So please know that these videos are just for entertainment and educational purposes only. And then here are some of the sources that are cited. You can pause this to get some of these links, or in the PDFs that I post, if you want to go to some of these sites, feel free to do that. So thank you. I hope you found this video helpful. I did post the daily video for Monday. Here's the weekly video. I will be preparing the intermarket analysis video and then the deep dive video as well. So I hope you have a great weekend, and I will talk to you in the next video.